It's difficult to tell when to sell, which is why most investors hang on for dear life. Take a look at investments in general, and you will see that the majority of those who attempt this are really unaware of what's happening. They simply ride the wave. Overwhelmingly, they don't end up in a good position prior to or during retirement, but without knowledge, they do so anyway. Insiders, however, are in the know and they lead the trend. You came here for the truth, so let me unveil that for you. Today we are going to look at what insiders are doing, and guess what? They're selling at the fastest rate since 2007. I'm going to link that in with some other information that tells us where the economy is at today. We're going to look at some other facts, and I just wanted to bring it to you in this one video, so let's get into it right away. The leaders of corporate America are cashing in their chips as doubts grow about the sustainability of the longest bull market in American history. And there's no doubt about this because we have seen this bull market go on and on and on. It was supposed to come down in 2015, 2016. That was very clear. And yet it progressed even further. My goodness, it went years beyond that. Today where we sit, there are so many imbalances all over the world. Things have never been like this before. We've had events that occurred with major inflations, with hyperinflations, with central banks printing money. We've seen that. However, we have never in history seen a complete global concerted effort to print money. That has never happened before, the effects of which we will have to witness as time goes on. Corporate insiders have sold an average of $600 million of stock per day in August, according to TrimTab's investment research, which tracks stock market liquidity. August is on track to be the fifth month of the year in which insider selling tops $10 billion. The only other times this happened was 2006, 2007, the period before the last bear market in stocks. That should be telling to people because they are in the know. They know exactly what's happening, or at least they have more of an insight as to what's going on with their corporations. And we're talking about FANG stocks, technology stocks, all the big names that you have seen and perhaps invest in. Well, those people there haven't sold this much since 2007. Now, that doesn't mean necessarily that it's going to crash tomorrow just because Mark Zuckerberg is selling some stock. No, but at least it tells you what they are doing. It gives you insight as to details about these insiders. Investors often view insider buying and selling transactions performed by top executives, leading shareholders, and directors as a signal of confidence. Even though the stock market is much larger than it was in 2007, so the $10 billion mark may not seem as much now as it did then, the acceleration of insiders heading for the exits could indicate concern about the challenges ahead, especially because of the US-China trade issues and the potential for recession. It signals a lack of confidence. When insiders sell, it's a sign that they believe valuations are high and it's a good time to be outside of the market. That doesn't mean they're going to sell off all of their shares. They simply take profits, and maybe they move that into safer investments. Maybe they're going to move it into bonds. Maybe they're going to move it into cash. This information doesn't tell us that. All we get in this particular video that I'm bringing you today is simply that insiders are shedding some of their shares. And just to finish this point off before I move on to the next one, the TrimTab's report makes it clear that insiders are selling more than they have at any other point during the bull market, which began in March 2009. Top executives from Salesforce, Slack, Chipotle, Visa, and Home Depot all sold shares. And that's according to Open Insider. I believe I have shown you this before, and there might even be a video about this in my free e-course that is available on my channel and on my website. I do believe I broke down exactly how to get that for yourself if you're interested. Buybacks, another sign of confidence, have also slowed, albeit from extremely elevated levels. I have covered the buybacks extensively. This has slowed down, but we're talking about $1.1 trillion last year. So we'll see where this year ends up, but we're still talking an excessive amount. They are the biggest buyer. There's no doubt about it. Now, if you look at what happened during the previous recession, as soon as those earnings start coming down, as soon as the valuations start coming down, you don't have the buybacks occurring like they did before. They wait for prices to fall, then they buy back in. That's the way this happens. They're not going to continuously buy if they believe that the stock prices are heading further south. There's more details in here about that, but I'd like to move on to this. Global GDP slowdown. You can see the US, the EU, France, Canada, UK, Japan, Germany, Italy, everybody has moved lower. Now, some of them are doing better than others, but we are witnessing today that basically all around the world, for the most part, these countries are not where they were at one point. At one point in the last, this shows us basically from 2017 up until present, we had seen better growth. Now today, not the case. If you pull this chart way back, you will see it looks even worse than this. We used to have growth that was much better. We're talking about double the amount of growth, and now they can barely squeeze out anything. Take a look at Italy, for instance. We're seeing a contraction phase that is taking place, and of course, as I have mentioned over and over again, this is a global phenomenon. Wall Street sees elevated recession risk, market woes after US-China trade fears. I'm sure you've been following what's happening with the US and China going back and forth. Was there a phone call? Was there not a phone call? Yes, we're having talks. No, we're not having talks. This is a mess, okay? Nobody's going to resolve this the way that they're doing right now today. There has to be something put on paper. Until that moment occurs, we are going to see volatility. The market will absolutely love it if both sides agree to something, anything, and actually get it on paper. Until then, we're going to see up, we're going to see down. Some Wall Street strategists are warning clients about elevated recession risks and market dangers after the US and China escalated their trade issues last week. I do believe that up until the Federal Reserve meeting in September, we could definitely see some high-risk events occur. Should the Federal Reserve cut interest rates at that meeting, of course, the market is going to love it, okay? Even if we have some sort of emergency event that occurs, I don't see that as happening because of the way the market is right now, because of the jobs numbers. Everything, according to their statistics, looks very good, so I don't see an emergency coming up. But surely with what we have seen right now, the market is begging and pleading for a rate cut. If they give them that, then certainly the market can go higher, even though the tensions between the US and China are ever present. The FANG trade is losing its bite. Owning shares of Facebook, Amazon, Apple, Netflix, and Alphabet has given investors little upside over the past 12 months, depriving the long-running bull market of one of its biggest drivers. All the stocks, with the exception of Alphabet, peaked last year and remain well below their records after a brutal sell-off last fall, wiping out billions of dollars in market value. The stocks have shed nearly $415 billion since August 2018, when their combined market value swelled to $3.7 trillion. Now, we have seen a bubble that has appeared. Many have referred to it as the dot-com bubble 2.0. That's up to you to decide, but regardless, what we have seen is that although there are so many people pushing these stocks today and over the last year because they want to see them go higher and higher, these stocks as a whole, the FANG stock trade, has not performed well over this last year. So that's important because we have seen so much quantitative easing, so much positive publicity for these companies, and yet they haven't been able to push higher. What does that tell you about the underlying strength of the market? There is extreme volatility despite what we have seen with the VIX index that gets pushed down on a daily basis. There's no possible way that this can actually be fixed. The underlying root cause, it's impossible, absolutely impossible to resolve by printing money. It is never going to work, and yet here they are. Despite a sharp rebound in the first half of the year, the shares have struggled to reclaim their highs, a trend that is mirrored in the S&P 500 and other major indexes. The S&P 500 is flat since mid-2018, despite a 15% jump from December. Any significant rally rests on the participation of the FANGs or the emergence of a new group of stock market leaders. Now, this is embarrassing because if you look at what has happened with the markets, they are relying on the Federal Reserve to usher in a new cycle of quantitative easing. If that doesn't happen, we are not going to see new highs. There are two major factors here. Obviously, we need the Federal Reserve and other central banks around the world to get easy. And we need the China-US trade deal to actually be signed in paper. If that could ever happen, doesn't look like it will, but here we are. And the reason that I always pick on the FANG stocks, or I say 7 shares of Amazon, is this. The FANG stocks together account for nearly 20% of the value of the S&P 500, giving them considerable influence over the direction of the stock market. These are by far some of the most important stocks today. So much has gone into them, not just their actual market cap, but what we're looking at is the media, the propaganda surrounding them. It's as if they can do no harm, no matter what Facebook does. It seems like they are able to maintain this status, and it really shouldn't be the case. 20% of the value of the S&P 500. Now, of course, you're always going to have stocks. If you look at it 50 years from now, whatever stocks are popular then, there's always going to be a handful that are extremely popular, have big market caps, and so on. But this usually happens particularly at the end of a cycle. The wealth is concentrated further and further, and then when the bubble pops, you see that these come down the most aggressively. A sell-off worse than December can arrive in a week, says analyst who is predicting a Lehman-like drop. Now, I'm not specifically suggesting that this could happen. I think that it is a little much to try and predict something like this. I mean, they're looking at the technical analysis saying that it is basically mirroring what we've seen before. However, I never like to try and time it this way. It 99.9% of the time never works out, and yet there's always somebody who does this out there. In this case, I just wanted to show you it because it's going to lead me into my next point. So it's just interesting. That's all I wanted to show you. But in general, this is what it really comes down to. Recessions are never good for anyone. A sputtering economy means miserable financial, emotional, and physical health consequences for everyone from infants to retirees. But the next one, if it happens, when it starts happening, stands to hit this much maligned generation particularly hard. For adults between the ages of 22 and 38, after all, the last recession never really ended. That is so important to understand because what's going to happen to this massive group of people is that they are going to be hit so hard they may never in their lives recover. Millennials got bodied in the downturn, have struggled in the recovery, and are now left more vulnerable than other older age cohorts. As they pitch towards middle age, they are failing to make it to the middle class and are likely to be the first generation in modern economic history to end up worse off than their parents. The next downturn might make sure of it, stalling their careers and sucking away their wages right as the millennials enter their prime earning years. We've got a big problem going on today, and I assure you, all of that quantitative easing that everybody is so anxious, so desperate to get, and unfortunately, all of this is not going to create prosperity. All of that helicopter money that everybody is wanting, they are wanting this because they said, Wall Street got it last time, I want it this time. If you're going to print money for those banks, you got to hand it to me as well. This will never fix anything. We have to reject the notion of quantitative easing. We have to say no to this. But of course, nobody really gives a damn. That's all for this video. If you found it informative, please hit that thumbs up button. I really do appreciate it. If you want to know how to make your own money, how to bring in income aside from your 9-to-5 job, aside from anything you may have ever been aware of, there is a way. I created a free course. It's a step-by-step guide to sell on Amazon. I call it the Amazon GPS. It is completely free and there are new free updates all the time. So definitely get in. It's at theamazongps.com. If you want the financial education that was left out of the school system intentionally so that you don't learn, so that you don't figure this out for yourself, so that you must rely on others, these 2 books will teach you everything that you need to know. Check them out at the link in the description. It'll bring you over to Amazon where you can flip through the pages for yourself. If you want the audiobook, that's available at themoneygps.com. Hang on, hold on. Do you know what central banks are up to? The reason why they do what they do. I talk about it in this video. Click on it and I will see you there.